Thank you so much, Gordon. It's really inspiring to hear you speak and also to hear Dean Sundaran. I am so lucky to be working with people like you whose mission and work really support the shared goal that we all have of having a better world and a more sustainable future. I also want to thank our sponsors, as both of you have done before. And I would like to thank as well all of those who have come to speak at the conference, who have come to moderate at the conference, and also our terrific Center for Sustainable Business staff and team who have both organized the conference and managed and developed the programming that you'll see here today. So I am now going to share my screen. Excellent. So it's my pleasure to give us all a brief summary of the type of work that we've been up to at the Center for Sustainable Business over the past year. For those of you who are not familiar with the Center for Sustainable Business, our vision is a better world through better business, through preparing individuals and organizations, through education, through research, through giving them the practical tools that they need to really embed sustainability core to business strategy and drive better financial and societal performance. On the education side, in addition to our undergraduate and graduate education, we also do a lot with executives, both bespoke and general enrollment courses. A little brief commercial, April 4th through 8th, we have a online live course on offer for executives in ESG investing and sustainability. So right now, I'm going to give us a brief overview of some of the research we've been doing, and you will hear more about this in more detail in the variety of different panels, fireside chats, etc. So the four areas that we're going to talk a bit about are: what are the latest consumer sustainable purchasing trends? How can the private sector work with government and civil society to scale up investment in the UN Sustainable Development Goals? And we, with our campus here in New York City, have focused on doing that in New York. How can we best support private equity to do what they do well, which is to bring capital to companies in an effort to scale up sustainability, but also hold it accountable when there are negative stakeholder outcomes from their approach? And finally, how do we assess the business case for sustainable and regenerative agriculture in order to improve decision-making and ensure more investment in the pivot that people are demanding around agriculture? So I'm not going to steal the thunder of Randy Kronthal-Sacco, who is our senior research scholar leading our market research work. She tomorrow will unveil the latest in our Sustainable Market Share Index, which is a partnership with IRI, who provides all the barcode data in the United States from every mom and pop shop to Walmart and Amazon, and will show us what's happening around purchasing. But just to give you a sense of what we've been seeing over the last couple of years as we provide this information every year, through 2020, we saw about 16.8% of total consumer packaged good products were purchased as sustainable. And that we saw a significant growth in sustainable products. In fact, in virtually all of the categories, sustainably marketed products were outstripping the conventional categories. So you can see here, some 10 of these categories had more than 150% growth. The purple bar is the sustainably marketed part of the category, and the blue is the conventional. So this is an area where the growth and innovation opportunity is really significant. We also have done research around the premium, and we will, again, just as in the way you will see in the latest in market share information tomorrow, we will also share with you the latest around premium. As of 2018, the premium was around 39%. So we saw significant growth in sustainable products alongside of a premium. And as part of that, we saw that there was lower price sensitivity. In other words, consumers are willing to pay more for sustainable products. And we see this across not all categories, but most categories. And again, we'll show you an update on this type of information. We also looked at whether or not there was a difference between in-store and online performance. And there we found that indeed there was even more purchasing online of sustainably marketed products. And this is a trend that we're seeing supported by things like at Amazon, their climate friendly pledge, which enables customers to find more sustainable products online. So moving on to our next area of research, which is around scaling up financing in the Sustainable Development Goals, led by our project director, Mariana Koval, along with Wythe Marshall, Chet Van Wert, and other team members. We have been working with New York City, who was the first city in the world to align its sustainability plan with the UN Sustainable Development Goals. Working with the city, with the UN, with the private sector, with local community organizations, we are aiming to design projects that will both create inclusive development and green development, as well as jobs. In this approach, we're identifying projects that allow for a positive nexus between the corporate sector, the public sector, the financial sector, and the community. Certain areas that we focus on are the built environment, food and health, renewable energy, sustainable mobility, and waste. These are the various projects that we've been developing with partners, and partners is very much, I don't have the ability to go into all of the partners now, but really significant engagement with a variety of nonprofits, business leaders, and government agencies. I'll talk a bit more about the built environment focus, and we will have a panel on decarbonizing the built environment tomorrow. In addition, we've had significant funding from the Mother Cabrini Foundation, following on support from the New York Community Trust, to measure and map agricultural food production in New York City, to develop a plan for, as we see, the decommissioning of the prison on Rikers Island to bring potentially a commercial indoor farm to the island. Working with the New York City Housing Authority and Green City Force, helping to bring both small business opportunities and nutritious food to communities, and a variety of other sustainable food projects. Another project we're working on is around sustainable mobility, very exciting initiative to help frontline workers access with low-cost financing and subsidies electric bicycles and scooters to enable them more easily to get to work and with a lower carbon footprint. We're also exploring a variety of waste-based projects, including, for example, supporting low-carbon concrete that uses ground glass pozzolan from glass waste. So a variety of different initiatives. And the one I want to focus in on for a minute is around decarbonizing New York City's built environment. So 70% of New York City's greenhouse gas emissions come from the built environment. And in this city, we have one of the most far-reaching government regulation, the Climate Mobilization Act, which aims to reduce these greenhouse gas emissions through a variety of different both carrots and sticks. And the penalties are the sticks. The carrot is supporting financing to fund energy efficiency retrofits. At Stern Center for Sustainable Business, we've developed a free public data tool with buildings that are under what's called the Local Law 97, that's part of the Climate Mobilization Act, that enables us to understand, and this little map you see on the left shows us the buildings. The buildings that will be affected by this law, sortable by their greenhouse gas emissions, their ownership, who holds the mortgages, and what the penalties might be, which can help us with outreach to really focus on the worst performing buildings and also engage in ensuring that there's capital going to these buildings. What are some of the challenges? Well, the building owners generally have no incentive to reduce emissions until 2030 or later. And as we've heard, we really need to move on this more quickly. Also, in order to get a loan to finance the energy retrofit, you have to get a consent from your mortgage holder. At the same time, mortgage holders will be required to support Scope 3 emissions to the SEC, including emissions from their borrowers. And we're already seeing some banks begin to disclose the emissions associated with their lending portfolios. So banks could be a really fascinating and exciting partner in unlocking capital and improving the GHG performance of their mortgage portfolios. So in sum, we hope to work with financial institutions, banks to help them reduce their Scope 3 emissions, those coming from their mortgage lending, and work in particular on high carbon emitting multifamily property buildings. So just to give you an example, as we can look at this, we can see that, for example, JP Morgan Chase's portfolio under Local Law 97 generates a significant amount of carbon, of greenhouse gas emissions, and 55% of the mortgages held by JP Morgan Chase have a D rating around emissions. So there's a huge opportunity for JP Morgan, one of the biggest mortgage holders in New York City, to really decarbonize their portfolio through engaging in this initiative. So again, more on decarbonizing the built environment tomorrow. So moving on to the next research that we've been working on, and again, this is a work in progress. We've been looking at how we might support the development of a responsible investing framework for private equity. Uma Chandra Balakumar and myself have been working on this together with Paul Fowler, who's done a deep dive case study for us. And we've been partnering with organizations like the Pre-Distribution Initiative, United Nations, Principles for Responsible Investment, private equity folks, and Ceres, and with support from the U.S. Endowment for Forests and Communities. So why private equity? Well, it has significant sustainability and economic impacts. The global private equity market was around $7 trillion in 2022, projected to grow to $9 trillion by 2025. And in the United States, about 6.5% of US GDP is supported by the US private equity sector, about 1.4 trillion worth, about 12 million people employed by the companies owned by the US private equity sector, and at close to $1 trillion earned in wages and benefits by these workers. So really significant social impact. Private equity has the opportunity to create sustainable growth and support a variety of positive stakeholder outcomes. So our project is around assessing the impact of private equity management practices, both at the firm level and at the portfolio company level, the companies that they own all or part of, through the lens of responsible investing and also creating values for shareholders, stakeholders, and the company. To formulate a framework of responsible private equity management practices, and also to engage with the general partners at the private equity firms and the limited partners at the asset owners to support pathways towards responsible investing and support those private equity firms that indeed are really contributing to both better financial performance and better societal performance. We've done a deep dive, and I'll share a little bit on that, into a Wisconsin-based pulp and paper company who went through two private equity owners as sort of a look at what are some of the challenges that we see around private equity ownership. We've looked at more than 60 research studies over the last 10 years or so that study the impact, positive and negative, of private equity. And we have been talking with a variety of private equity firms, as well as advocacy and industry associations to get their feedback on what would be helpful, again, to provide pathways for responsible investing. So the Wisconsin case study undertaken by Paul Fowler, Professor Paul Fowler, Looked at a case of a company called Consolidated Papers, which was one of the largest pulp and paper companies in the United States, a family-owned company until about 2000, when it was sold to an international pulp and paper company called Stora Enso. That company bought it right at the time, and also overpaid for it, frankly, bought it at a time when the dynamics around pulp and paper were changing radically. And so in combination with the paying too much for it and with the changing demand for the types of paper and paper products, Stora Enso's performance suffered. They decided to sell the pulp and paper company. They sold it to New Page, which was a private equity-backed forest products firm. They acquired these North American assets. They, in that process, divested themselves of a number of mills. They reduced the R&D development. They let go a number of employees. But they did not invest in any sort of pivot that was needed like the rest of the industry was doing based on sort of what the paper trends were at the time. They also went through about 7 CEOs in as many years and ultimately went into bankruptcy. They were then acquired by Verso, another private equity-backed firm that took on the debt-laden company. I should have mentioned as well that there was a massive amount of debt that went along with this, and began to, again, sell off more assets, let go people. We did not see any investment, again, in making the pivot that we saw other pulp and paper companies make, including ones owned by private equity. We also saw turnover of CEOs virtually every year. And again, we saw a bankruptcy most recently last year. So what did we learn from this particular case? That there are certain indicators that one can see around problematic private equity management. We see an too much of a focus on financial engineering, where there is high levels of indebtedness. They recapitalize in order to pay shareholder dividends. That Chapter 11 bankruptcy is used both to reorganize, but also as fees for the private equity firm. A lack of strategic investment, so elimination of R&D, no investment in needed new capital assets, selling off strategic assets, no sort of strategic pivot. CEO turnover. We also saw compensation that was tied to actually short-term cash generation and selling the company, and dissatisfied stakeholder actions. Now, this is a one-off example. We have seen in our research quite a few other examples of this type of behavior by some part of private equity. In fact, Professor Sabrina Howell at Stern has done a lot of research on this in healthcare and education, and found similar challenges. But that is just a small part of private equity. There are the majority of private equity who really look at the other side of the coin. And here are a few examples of how private equity firms have been driving positive societal and financial impact. For example, HCAP Partners ensured, in terms of a responsible exit, that there was a significant bonus pool for all employees, including low minimum wage earning employees, that they got significant benefit from that exit. We see Closed Loop Partner also investing in companies like Balcones, which is the largest privately held recycling company in Texas, who's been successful financially, also working to hire DACA recipients, really reach diversity targets across all aspects of the company. We see Carlyle Group, who has secured one of the largest ESG-linked U.S. credit facilities, $4 billion, and a goal to get to 30% board diversity across all its portfolio companies. And Towerbrook, working with a company like KIHI, which is a certified B corporation, employee-owned, but also working with more than 100 other B corporations, benefit corporations, who are managing to triple bottom line. So really a huge opportunity in terms of pathways to the transition that Gordon talked about, using capital to really bring us to a more sustainable future. So our responsible investing framework that we are building, and this is not a final deal yet, we'll be putting this up on our website for comments, and we'll be issuing a white paper on this by the end of April. So we're looking first at the private equity firm level to understand how is the firm performing on management and human capital issues, on how they're managing their funds, on strategy and innovation, and on societal impact. And I'm not going to go through all of these sort of sample data points, but as you can see, we hope that people will look at that the private equity firms themselves, investors in the firms and others, will work together to ensure that there are, for example, diverse boards and deal teams, that there is good ESG knowledge amongst the employees of the PE firm, that there's aligned incentives and management policies associated with ESG outcomes. On the fund management side, that there should be transparency around financial performance, around how those finances are reported, and on things like what types of fees are being charged, and what kind of tax structuring we have. On the strategy and innovation front, we want to ensure that there is long-term horizon and investment sourcing that aligns with the societal impacts in terms of ESG and UN SDGs. For example, one of the things that we're seeing is a push towards public firms, energy firms, to divest themselves of their dirty assets to then be purchased by private equity firms where there's less transparency around that. We also want to see, as we saw in some of these examples, how PE firms are really contributing to net zero, to living wage, to DEI, and how sustainability is really embedded in that company, and that there is really sufficient and transparent reporting, not only at the PE firm level, but for their portfolio companies. Moving on to the portfolio companies, right, and their management by the PE firm and what types of areas we should be looking at there, pretty similar. We want to be looking at management and human capital, reporting transparency, again, strategy and innovation, financial engineering and leverage, and societal impact. So here, in addition to the topics we talked about for the PE firms themselves, as I mentioned at the very beginning, private equity has a lot of jobs, right, and pays a lot of people. So we want to make sure that indeed that there's the type of transparency and support for employees that we're increasingly demanding in society. And there have been studies that showed that the retail operations with frontline workers owned by private equity firms are less likely to have a $15 wage than the publicly owned firms. Again, there are exceptions to that, but something that needs to be paid attention to by both the PE firms and the investors in the firms. We also want to look at what is the net job creation, right? How are we dealing with if there are redundancies and exits that have an impact on human capital? How is that human capital be given an opportunity to train and be provided an easier exit? How are we engaging with, at the company level, with a variety of different stakeholders? Then, as we've talked about, ensuring robust and transparent reporting around ESG and financial performance. At the strategy and innovation level, that there are really capital allocations being made that reflect the overall sustainability commitments. This is an issue we see in public companies as well as privately owned companies, that there are appropriate investments being made in whatever transformation or pivot is needed, that we're looking at value chain risks and resiliency issues. And as we look at mergers and acquisitions, which is a common area in this space, how are we including ESG in this? How are we improving our strategic positioning from a sustainability perspective? Financial engineering and leverage, as we saw from the Wisconsin example, we want to make sure that we are not overly leveraging the company, that we're not doing things like appointing bankruptcy experts to the board instead of people who are specialists in the business, that we're using capital structures for positive impact like ESG-linked credit, and that we are careful about our tax structuring and accounting. And then finally, again, as at the PE firm level, that we really ensure that sustainability is embedded core to the business strategy of the company, not a sort of corporate social responsibility issue off to the side, and that there are KPIs associated with that ESG performance that are reported on, as well as, that are reported on. So our next steps here, we'll be publishing a white paper on this framework with cases that provide pathways to positive societal and financial performance. You'll hear tomorrow on our PE a panel from a variety of different private equity players who are doing really interesting and positive work in ESG and in responsible investing. We'll engage stakeholders in the review and feedback on the framework, and then we propose to develop responsible investing tools that can help the private equity sector as well as the investors with things like a due diligence questionnaire, tools for communities to understand and think through the role of private equity in their communities and so on. And finally, we hope to have a private equity for responsible investing summit in 2023, which we'll be sharing with you all. And now my final area of research to talk about before we get into our first panel is the work that we've been doing in our return on sustainability investment methodology around food and beverage. If you remember from last year, we presented on our sustainable apparel framework and the work that we were doing there. Here, I want to call out our researchers, Chisara Emere, Senior Research Lead for ROSI, Elise Douglas, who is the Senior Scholar for ROSI at Stern, at CSB, and Ritu Raman, Divya Chandra, and Maggie Peruta, all on the ROSI team. I also want to thank HSBC and Invest Industrial for their funding of our work. So for those of you not familiar with the return on sustainability investment methodology, we've identified 9 mediating factors that drive better financial performance when a company embeds sustainability in its strategy and its practice. Those 9 factors are improved customer loyalty, better employee relations, more innovation, improved media coverage, improved operational efficiency and risk management, and better sales and marketing, supplier relations, and stakeholder engagement. Any good management, of course, can drive any of those benefits, but what we're seeing is that actually sustainability and ESG are driving many of those factors and therefore greater profitability, higher valuations, and lower cost of capital, ultimately better societal performance as well as business performance. On the right here, you see some of the companies that we have partnered with around ROSI. With that model, that methodology, we then work with industries and companies to identify what are the material ESG issues and strategies. We then look at the practices under each of the strategies, and it's at the practice level that we can then monetize the return on sustainability investment through defining benefits, quantifying those benefits, and monetizing them. So in food and agriculture, it's a complex sector, as all of you know. And we have identified 12 different strategies, some of which are regenerative, some are broadly sustainable, around that the industry uses or should be using. Everything from improving soil health to animal welfare to food waste and circularity to employee and supplier well-being. And to give you an example, I mentioned we go from a strategy. So strategy might be improving water security, to then an evaluation of the different types of practices, so then we can monetize those practices. So 2 broad practices are to reduce water use and to improve water quality. Under each part of the value chain in agriculture, there are different ways in which that will manifest itself on farm, of course. There's a variety of different techniques that one can use that will reduce water use and improve water quality. Similarly, in the other parts of the value chain. So 2 examples, partnering with Arca Continental and ALO Advisors, who has been working with us on ROSI for years and has a really strong competency around water, they worked to apply ROSI and identify to water risk for Arca Continental. And you'll hear more from Arca Continental in the upcoming panel. So I won't steal their thunder, but they found more than $200 million of regulatory and reputational risk associated with the plastic packaging of the bottling that they were doing, and up to $200 million plus in operational risk associated with supply risk and water stress. So water is just a growing area of financial risk for companies and an area for needed investment. And that's one of the areas we're looking at. Another project we worked on was with Blue Triton Brands, a private equity firm, or that was bought by a private equity firm, formerly Nestle Waters, North America, and again, working with ALO Advisors, looked at 2 major areas. One was associated with, or really it was all associated with the uptake of a credible third-party water stewardship certification. And we found on the market side, it delivered about $1 billion in revenue opportunity through the work that Randy had done around Randy Cronthal-Sacco around market demand. And then in addition, ALO looked at the monetization of applying this third water stewardship in areas where there is significant risk. And we looked at a wide range of risks in the areas where their manufacturing facilities were located or where the water was coming from. And we looked at the consequences of government policy and regulatory action here. And we looked at valuation of the company with or without the third-party certification, and found that indeed, particularly in areas where there was moderate risk, when there's very high risk, water stewardship, water certification probably wouldn't have enough of an effect because it was so challenging. And where there were areas where there was very little risk, probably not all that much improvement. But in areas where there was moderate risk, we found a significant benefit. I'll give you another example of the type of practice mapping we're doing, looking at mitigating, adapting to climate change in the agriculture sector. Again, 4 practices that we can look at: reducing greenhouse gas emissions, transitioning to low carbon alternatives, sequestering carbon, and selling and purchasing offsets. And again, for every part of the value chain, there is a different articulation of that. And for each of those areas, you can go in and figure out what is the net financial benefit of that type of activity. Some of the case studies we've developed, we worked with Cargill. You'll hear from them later, looking at palm oil and soy. And for example, when U.S. soy farmers employed soil management practices that improved carbon capture, amongst other things, they had net and tangible benefits of up to $145 an acre. Around deforestation-free supply chains, we saw cattle ranchers in Brazil benefit from better agriculture practices financially. You will hear from McCormick in our next panel, again, where we looked at sustainable sourcing benefits for them, total benefits of $6 million in 2019 related to that work. And we've also worked with Natra, sustainable cocoa company, also improving, and Natra owned by Invest Industrial, a private equity firm, really focused on sustainable cocoa sourcing. And you'll hear from Invest Industrial tomorrow on private equity. On the employee and supplier well-being side, to show you again the 4 types of benefits that you can see practices that you can implement, and then all the different ways that those can be implemented. And just to show you how we go from there to monetizing, you can see here one practice is to ensure fair compensation. Then we can look at what are the benefits, and then we can figure out how to monetize them. So metrics associated with ensuring fair compensation could include increased retention, leading to lower hiring costs, leading to lower vacancy costs, improved ability to attract talent with improved productivity, improved supplier resiliency related to fair compensation, decreased risk, right? So a series of different ways that we can go in and monetize this. These are some of the projects that we have been working on or will be working on with companies that we're engaging with this year on building out this the framework. Just checking on my time here. Here are some of the companies that we're happy to be engaging with, and you will be hearing from some of them on our panel shortly. I also wanted to let you know that we will be launching shortly our ROSI, Return on Sustainability Investment Research Database 2.0. There already is a ROSI database available for you now, but we've been updating it to include all the studies that we can find about the relationship between ESG and sustainability and financial performance, and also map it to benefits such as employee engagement or innovation or operations, so that you will have these tools as you do your own return on sustainability investment analysis to use as proxies to help you determine financial benefits. So I hope that you will get involved with the Center for Sustainable Business, and there's a variety of different ways to do that. As I mentioned, we have our executive education program on ESG investing coming up April 4th to 8th, but plenty of other ways in terms of research. The research projects that I shared with you, we'd be delighted to have partners on them. And really, again, look forward to working with you, and want to thank all of our corporate, nonprofit, academic, and government partners for the great work that you're doing, for working with CSB. And also, most importantly, I want to thank you for your support of our students, for supporting them in their learning journey, as well as with internships and employment opportunities.